Good evening and welcome to the Shadow Trader Video Weekly for Sunday, February 5th, 2012. We're going to talk about three main topics today. The first one was my call on the S&P to stop at this trend line here, which is obviously dead wrong now, right? The pullback was very, very minor. The market has gone higher. So more on that in a second. The second thing we're going to talk about is action in gold recently and where we might be able to make an entry to pick up more GC contracts or make a first entry after this big move upwards. And the third thing we're going to talk about in today's video is a short primer on an option play called Broken Wing Butterfly that is quite effective, and I talked about it on the show recently when I was a guest for Brad for a few days. And I've also been getting a lot of emails on it since that time, and I did a Broken Wing trade live sort of where I gave the strikes and I said, look, it's pricing out at X and let's check it. And then a week later we went back and checked it and it priced out a lot more favorably. So there was definitely something to be there and people got very interested in that. And I also have a Broken Wing Butterfly trade happening right now in one of my accounts, so I'm going to go through that as well so you can see the intricacies of how it all comes together. All right, so first things first, let's talk about the S&PX. In late 2011 and at some point probably in January, you'll remember in the videos that I was talking about this trend line here, which is the dominant downtrend here in the S&P from the May highs of 2011, and I said I think that this will be the high of the market for the year for 2012 when we turn here and come down. That has obviously not been the case. That assessment was very wrong, which is not really impactful to me, at least, just so you know. I mean, I don't feel I need to justify myself, but I think you guys pretty much get the gist of what I do personally from watching this stuff so long, that I'm really a very short-term trader, and I don't like pile a whole bunch of money into the market at a certain turning point and then sit back and wait and say, oh, okay, that's the low for the year, and make this giant move. To me, it's an accumulation of a lot of small moves. A lot of it is day trading, options, etc. So it doesn't really matter to me that the market actually went higher, but it is definitely worth mentioning that the assessment that I made in a number of videos was wrong, and that this area here at the trend line did not turn out to be the peak. I was saying that there could be a move up and an overshoot, and we did get an overshoot here, and then the pullback that I was expecting did occur. But notice that the pullback was so short-lived, and we created a lot of balance in the same area, which I talked about in past videos. And then from that balance area, the market has moved up very, very sharply since then. So ahead of us, we really only have now resistance up in here at the 1360 to 1370. Remember, this high here is going to be in play, and that's the 1356. That high is actually 1356 and a half, 0.48, and then we have this high here, which is the 70.58, which is right here. So that's obviously where the market wants to head. As I always say, it just doesn't make sense that a market would get relatively close to an area and then not break through. Okay, so obviously things are bullish. Look to continue to buy stocks on pullbacks or at horizontal supports or trend line supports. All right, let's look at GCs for a second. This is the recent action in gold. Just to recap, been talking about a major trend line break here where we came through this area in the past about a week ago or so, right, where because of the Fed meeting that happened, FOMC keeping rates on hold for longer than expected. Obviously, this is bullish for the metals, and notice that the weekly bar has been very strong and broke through it. All I wanted to point out really here is that where the entry would have to be on the trendline support, obviously, right? So this one that I've drawn in is going to be key, correct? Notice that the 1700 area does tie in with prior highs here, which makes sense to me. Also, there's possibility of a kiss of the backside of the trend line and then go higher. This 20 MA here on the daily should also catch price. There's also an important point to mention here is that, and this happens in all time frames. Remember, sometimes I talk about different plays that are kind of like plays you have to take. Well, whenever there's like a huge body candle, you always want to look at an area that's 50% retracement of that big body candle. So this also ties in well with the 1700 area, although it does a little bit lower. Generally, I'm of the opinion that whenever there's big body candle like this, for instance, wherever you see this big emotion, the low of that bar should never be violated. You can see here that like this is big emotion here that sets off this rally, and then when you pull back here, you don't violate this low, you pull back to a higher low. But then as gold gets tired here, this trend line breaks and you have a very large break and you fall pretty hard and you set up into the next support area, etc. So this is really an important event that's happened, I feel, in the GCs, where you had this big body move, big emotion, and I don't feel that the low of this bar should be taken out. If gold retraces all the way back to the 1650 area, then I would say leave it alone again. Then there's really not much of a play here. But if we can get a bounce off this trend line, which is what I'd like to be playing at the 1700 area, that would also, if you notice, put us about, say, less than a third into this bar. It would make a lot of sense. Then I feel that gold could easily continue on, up to the next level, which would be 1800. I would think that this resistance level here would be where it would be at. Notice that when price moved to here, this resistance level was already in play. It didn't get taken out, but it's already been tested. So I would think, obviously, that on a further ensuing rally, this won't mean as much, and we'll move to here, and you'll have a next target on the GCs at 1800. Then after that, if you look at a weekly, a longer term, right, if there's going to be consolidation at that area or any building of pressure, a new high would have to be imminent as well. Obviously, I'm relatively bullish on gold in the longer term, but if we do move over that price level, then there's really not much stopping it from putting in a new high in 2012, which, as I was saying, I would think would be like 2200 an ounce or something like that. But that sort of prediction really is meaningless. The main thing you have to do is always look at perspective of where is support and resistance in the near term, where is it in front of me in terms of resistance, where could I possibly go? If I was to fail, where am I going to fail to? Where's the line in the sand that says, okay, this is no longer working? So that's the perspective that I want to give of where to enter, and again, where, if you're faced with a pullback situation, where you have to just jump out and say, you know what, this trade is no longer working. My assessment wasn't wrong. I looked at it properly technically, but gold just didn't follow through. It just didn't do what it was supposed to do. So there's your areas right there. All right, let's talk about the broken wing butterfly trade. I'm going to use the SPX as an example. Pay no attention to this 5 contract limit sale here. That has nothing to do with the BWB. That's a separate strategy. I do a lot of S&P option stuff, relatively esoteric, and broken wing butterfly kind of plays into it. If you look at the position here, it's some people look at it as like spaghetti. It's kind of it's relatively convoluted. And I'm not going to get into deeply into what this whole strategy is. I want to specifically talk about these right here, which is the broken wing butterfly. You can see here on the weeklies, and I do want to favor the weeklies on this trade. I'm long the 1365, which is expiring on the 10th in the Feb 2s. And I'm short 2 1370s, and I'm long 1 1380. So the reason this is called broken wing is because the straight butterfly would be 65, 70, 75, but in this case it's 65, 70, 80. And what this does is it gives us long exposure between the 65 and the 70. There's a little bit more risk because in a straight fly, the S&P could go to the moon and blow right through it, and your only risk would be the cost you paid. Whereas in this fly, there's a risk of $5, right? Because notice that this long spread here is only 5 wide, and this short spread here is 10 wide. So 10 minus 5 is obviously 5. So you've got a $5 risk if the S&P goes all the way to 1380. But remember this: before the S&P goes over 1380, it has to get to 1380, and right now the S&P is at 1345. And the play in the broken wing butterfly is simply that because it's broken wing and it can be put on for even money or a small credit, the play is that as time goes on and you get closer and closer to expiry and move in the direction of where the fly is, the cost should increase, and then you will, of course, sell it for a credit. That's the play. In the example that I gave in the Squawk Box last week, I showed you where you could buy these broken wing butterflies for a 10-cent credit, one on the put side, one on the call side, and then as the week went on Friday, I got back on the show as a guest with Brad, and I said, look, the call side is selling for a $1.95 credit. So you would have essentially gotten it for free. You would have actually been paid 10 cents to get it, and then sold it for $2. So that's pretty good business, right? If somebody can pay you first and then pay you again. And so that's what makes this play really interesting. So if you notice right now, I'm actually long this spread, as I said. And if you look at here, on Friday on the 3rd, notice that here I put the spread on for even money. Right? This is something separate, so don't pay attention to these two sales. This is also a broken wing butterfly, but this is different. This is actually just a component of a different strategy. What I want you to focus on is these right here. So these 10 went off at even money. You can see they were filled at a net price of 0. And again, it's long the 65, short the 70, and long the 80 to cover. Okay, and if I look at my chart here, there's basically two reasons why I chose those strikes. One is as I go out here, right? I want to show you what I'm looking at here. As I go out in the chain, I need to find the last point here where I can actually get a credit or even money for my butterfly. So look here. If I go out here, notice that I'm in this spread, 65, 75, 80. But what if I went and I said I want it to be even further out? I want to put the 75 in the middle. And I want to go buy butterfly 1370, 1375, and to break the wing out to make it cheaper, right, I've got to use the 85s out here. Notice it moves to like a 40-cent credit. Okay, and this is being recorded on the weekend, by the way, so just so you know, when this spread is 70, 75, and 80, you're not buying it for a 15-cent credit. This is more like a 15-cent debit, but because there may have been, you know, these bid and asks aren't really right on the weekend, and you know, this is just, don't even pay too much attention to that. This is obviously going to be a debit because you can't buy a straight fly like that for a credit. But when you break out one of the wings like that and put 10 wide here, you should be able to get a credit. Now this 40-cent credit here also is not happening. Just be aware of that. This is important to note, is that you're going to be quoted all sorts of things. And on the weekends when the exchanges are closed, it's even going to be less accurate. But you're going to be quoted all sorts of things, and that doesn't mean you can fill it. So what you want to do is just, while the market is open, is look at different strikes and compare them, going out on the outer edges of the chain, out here out of the money, and price the broken wing butterfly at the level where you can get a small credit, going as far away from current price action as you can, okay, until you can no longer get a credit. If you keep going higher and higher, and all of a sudden it prices as 5-cent debit, and you try the next one, which would be like 80, 85, 95, and it prices out at like, you know, 20-cent debit or whatever. Okay, so that means you have to come in a bit. You have to come right into that sweet spot of where the market is willing to make the trade happen for either even money, as in my example, so all I paid was commission because it was 0-0 on price, or at a small credit. And don't be greedy. If you can get a credit of a nickel or a dime, that's fine, because remember, you're not trying to make money off the initial play. You're trying to make money and sell the spread for more later as time goes on. Remember that as price moves towards that butterfly, you're going to have intrinsic value in that first strike, but still only have extrinsic value in the second one. And because it's a weekly and there's a short amount of time, the play is that the volatility crushes a lot faster and comes more to the middle, right, where, you know, to the at the money. And then because you're selling something further out, that is going to obviously crush faster than the one that you're long of. And especially then if you can get the market to move right up into where you have that long delta, correct, let's say on the call side, moving up into it, then you really have a chance at a relatively big trade where like in our example from last week, the spread may trade for dollars and you put it on for nothing. Okay, so that's essentially the mechanics of the trade. Let's just recap the main points to keep in mind. Go outside of where value is. If you think, you know, value is right at the money here, go outside and price the different spreads of where you can find a credit. You know, and I can just show you the same thing like on the call side. Let's take like 1300 looks good at a middle because I can see that's where you have a whole dollar at the bid, whereas these are like in cents. So let's say it was 1300, 1305 to 1295. This is a good example on the put side. Notice that straight fly out here is a debit. And if I push this down to 1290, now it's only a nickel debit. So I still can't put it on as a credit. Maybe I need to go a little bit higher. Maybe I need to bring this up a little bit to 1310, move this middle one here to 1305, right? And then instead of this being 1300 for a straight fly, it would be 1295. Can't do it yet there. There's a 30-cent debit, right? So I've got to kind of just play around with it until I can find that sweet spot where I can find a small credit, and you can put the trade on for like I said, like it was done here, where you can see that, you know, I've managed to get the trade off for even money. Okay, so that's the thing. So look on the outsides of the chain, see where you can find it. Second thing is don't pay too much attention to pricing on the weekends. You're going to get weird prices. It doesn't matter much. You got to be looking more while the market is open. Thirdly, go at limit. Let it sit there. Try and get filled. You will not get filled right away. You need some movement in the market. This fly that was at even money sat there for quite a while before it got filled. I think it was sitting out there for a couple hours. So be very, very patient. Okay. Now, here's the fourth thing, which I haven't mentioned yet. Important. If you can tie in the front strike or the middle strike, okay, preferably the front one, with a resistant area in the market, that's a really good play to take. So in my example, correct, mine is a 65, 70, 80 on the call side on the Feb 2 weeklies. Look at where resistance is at 70. So I'm long the 65. I'm short the 70 right in the pocket of where resistance is, and then the 80 just covers it. Remember, just to kind of cap off the margin. If it wasn't, it would be a ratio spread of just 1 by 2, but it's a broken wing butterfly because you got 1 by 2 and then you've got the other one covering it. Okay? So that's another way of looking at it, is that some people look at the broken wing flies and they'll say, look, where is support on the chart or resistance? In this case, like on the put side, there's support. And how could I structure it so that if the market falls down, it'll fall down, say, into the long strike of the butterfly and not go all the way through, because I know that going to where the middle strike is going to be support. Okay? So that's basically it. That's what you need to look at on the fly. Analyze as much as you can. I'll give you one last tip. They work very well on the weeklies. They work on the monthlies as well, but the weeklies are a little bit more fun because you get a lot of difference in price action each day, and it only takes a week for it to play out. They work very well on the indexes, so you want to try to keep your analysis to SPX, Russell, OEX. I've never done it on the Dow. I've done it on those three. Seems to be okay. I generally favor the SPX the most because I trade so much ES that I like the S&Ps, and I'm really more familiar with that market than any other. It does work on relatively expensive stocks such as Google, Priceline, Apple, etc. Some of the stocks are in the hundreds of dollars a share. You can do it. The pricing is a little bit more difficult because the spreads just seem to be wider on the options, and you get in there. You have to really make sure to go at limit and try for the largest credit you can get, and just kind of hold out for that price. I really wouldn't even do the more expensive stocks for even money. I would just be looking at those only for credits, and that's also another positive of the strategy, as I was saying, is that if the market does not move, you then have one more way of winning, correct? Because you put the trade on for a small credit. Let's say the market doesn't go anywhere, so the value of the butterfly never really increases. You don't really get anything out of it. Maybe you put it on for a 10-cent credit, and then it's trading for a nickel or a dime or whatever. It's still trading at a credit. No big deal. Nothing happens. The market doesn't go there, so there's really no change in value. Well, you didn't lose anything because you were able to put the trade on for a credit. There's very few trades that you can do that with. All right, so hope that's of use to you. Email me at asktheshadow@shadowtrader.net if you want to discuss the strategy some more. And as time goes on, I will try to be a guest with Brad some more, and we'll talk about it live and whatever. And I will give you an update on this particular spread in next week's video. I'll give you an update on this weekly 65, 70, 80. I'll tell you how it prices out. I also tweeted it on Twitter, so remember you can follow me there at Peter Reznicek. That is in the right in the video here, in the beginning and at the end, and I'll give you an update there as well. All right, so that's all for today. Have a great weekend on behalf of myself and the entire Shadow Trader team here in beautiful Philadelphia, Pennsylvania. I wish you good trading and good night.